The Fed's kicking off its latest policy meeting. Our next guest has a new Wall Street Journal op-ed entitled "Don't Credit the Fed for Inflation's Decline." Joining us now on the phone, Judy Shelton, Senior Fellow at the Independent Institute. And Judy, let's say we don't give credit to the Fed. Is it just the end of supply chain issues and it was transitory all along? Is that your point?
My point is that if the Fed is going to talk now about possibly cutting rates, they're going to have to disavow their model, because the economy has grown, unemployment has stayed down in spite of what the Fed was expecting to happen by raising interest rates so fast. I think the model does not adequately take into consideration the impact of people working and the impact of economic growth. Neither of those two things are inherently inflationary. And if anything, what the Fed is doing is hurting supply by affecting business investment with high rates, and they're contributing to the fiscal excess, which is the real villain behind inflation, by increasing government debt financing costs.
They're in, I don't know when the Fed is not kind of between a rock and a hard place, Judy. It's tough, and I don't know what did you think of if former President Trump were to be reelected? What did you think of the three possible candidates? I saw you mentioned in a lot of the articles, but the three that were mentioned with a search conducted by Art Laffer was Art Laffer himself, and I think our friend Kevin Hassett, or the other Kevin Warsh.
Well, I don't know if that makes me an honorable mention or an also ran, but being in the top five, I guess, being considered, I'll take those odds. But I would say that I have tremendous respect for Art Laffer. He's really an iconic figure for me because he was the intellectual firepower, together with Robert Mundell as the macroeconomist, that supported the Reagan supply-side pro-growth economic agenda, which proved very successful. I think Kevin Hassett did an excellent job heading up the Council of Economic Advisors and continues to be a very effective advocate for the kind of pro-growth policies I support. I don't know Kevin Warsh well, but his background, he came up from Morgan Stanley. He was in mergers and acquisitions, and that might come in very handy at the Fed. It has in the past. Yeah,
he advises some pretty smart people in the investment community too, with what he's currently doing as well. And he's definitely the most handsome of the three. Becky, wouldn't you?
I don't know what you're talking about.
You have no opinion. Well, Art Laffer's fine, and Kevin's fine himself. Judy, what do you think Art Laffer, since you do admire him and know how he thinks, what would he be doing right now? What would he be urging Fed Chair Jay Powell to do at this point in time?
Well, if you boil down the supply side formula, it is stable money and low taxes. So I think he, as I would, and I don't mean to speak for Art, but I think that the problem is the constant ratcheting up and ratcheting down. I would have started a bit earlier after we saw inflation in July of 2021 instead of waiting until March of 2022 for liftoff. But by December 2022, when they got to 4.25 to 4.5, I would have stopped. At that point, you've normalized. The zero interest rates are no good for capitalism. So at 4.5, it's reasonable, and that's when the Fed should quit micromanaging. It should let markets and price signaling sort out how to reconcile demand and supply for loanable funds. So I think the Fed is too activist. It's the egocentric predicament. They think they have to be always involved in economic performance.
Right. And we have a pretty good economy without the Fed. They could get down there and there'd be no harm, no foul. Judy, it wouldn't be hard to get to 4.5. I know they went up too far in your view, but they could make good on that, couldn't they, if they got down to 4.5?
Well, not now. Not now. Not now.
Too late.
Because now they're not only saying that we won't cut until we hit 2%, but they also use that tool of paying big banks to keep the money sitting dormant at the Fed. And I think if they start to let that loose and make it not such a lucrative deal for the banks, that money, that liquidity goes into the economy too fast.